Jason, can you give us a line on how to approach mainland China and how compelling is that market on valuation, or would you be inclined to wait this one out until we see meaningful signs of stabilization, particularly with the consumer?
Well, I think that first, when you look at valuations, whether you're comparing that to the United States or comparing it to India, which of course is an alternative for many investors, it looks as though China is about 40% cheaper on average. Now, if you look exclusively at tech, or particularly fast-growing services firms, you see an even wider valuation gap. So, there's no doubt that there's more risk in China. The question that investors have to ask themselves is whether they're being adequately compensated for that. And I would say at these levels, the answer is clearly yes. I think secondly, what's been interesting about China, there's always this expected move or shift in the growth model towards the consumer, increasing the consumption share of GDP. What we've seen actually is a move from capital and credit resources going to housing, to the real estate sector, moving that to higher value added manufacturing, of course in semiconductors, of course electric vehicles, and other green industry. And so that seems to be the areas where growth is more likely to come from on a go-forward basis. I think it's, again, been disappointing for those who thought that authorities would lean more on the consumer. But I think when you look at export numbers, and again, you look at the fixed investment growth, it's delivering growth nonetheless.
Jason, if the US and China are butting heads once again over this issue of tariffs, then how concerned are you that supply chains are going to become gnarly? It's an expression the kids like, isn't it?
This is part of, I just think that this is part of the new. I just think this is part of the new world we live in. And this contributes, of course, to higher expected interest rates over time. It means that there's risks of periodic supply shocks. It means that there is much more upward pressure on inflation than we experienced in the past decade. But if you look at the U.S., for example, one of the big story of U.S. economic outperformance over the last year is really related to this fixed investment boom. Investment in industrial facilities in the United States is running today about 2.6 times its level prior to the onset of the pandemic. The drivers here are twofold. One, industrial policy. This is subsidies largely delivered through the tax system for green industry, renewable energy, and of course semiconductors. And then the second is just AI enthusiasm. If you look at data center construction, if you look at the planned CapEx of the mega cap data center owners, this is rising at about a 60% rate over the last 2 years. So much of this is, of course, competitive stance vis-a-vis China. And it's something that, again, is supporting growth in the near term. Over time, we'll see how this balances out. But certainly, again, more upward pressure on inflation, more demand for capital, both contributing to higher rates and expectations of higher rates over time.